$600K could vanish from your family's inheritance in 2026, and you won't stop it. Most high-income earners believe that having a will or trust protects them from estate taxes. The data tells a different story, and in the next few minutes, you'll see exactly where that $600K disappears, and more importantly, how to keep it in your family's hands. Research from IRS publication 950 confirms that a basic will or trust does not eliminate federal estate tax, state estate taxes, or the hidden income in respect of a decedent tax on inherited retirement accounts. For a married couple with a $4M combined estate, that gap could mean their children receive $600K to $800K less than intended, an outcome that becomes irreversible after death. But here's what surprises most people. Even with a $4M estate, you might owe zero taxes today, and $400K, $500K in 2026. The cliff is coming whether you're ready or not. Here's the crisis window. The federal estate tax exemption is $13.61M per person in 2024-2025. In 2026, that exemption drops to approximately $7M per person. That's not a gradual adjustment, it's a cliff. A $4M married estate owes $0 in federal estate tax today. In 2026 and beyond, that same estate faces $400K, $500K in federal taxes alone. Add state estate taxes and inherited IRA income tax, and families lose 20–30% of their wealth to taxes instead of passing it to heirs. Stick around, because the 3 planning gaps I'm about to show you are exactly what's costing families 6 figures, sometimes even 7 figures. The wrong belief is widespread. As long as I have a will or trust, my estate passes efficiently. The correct reality, per IRS publication 559, is that retirement accounts and IRAs face a separate income tax when inherited, independent of the estate tax exemption. Most basic trusts don't address this. But wait, it gets worse. What if I told you that even families who did set up a trust are still losing 6 figures because of one missing form? Let me show you what this looks like in real numbers. A high-income professional earning $250K, $500K annually, with a $5M home, $1M in retirement accounts, and $800K in business equity has already crossed the danger zone. Their estate hits $3M. Today, they're safe under the $13.61M exemption. But here's where it gets critical. When the exemption drops to $7M in 2026, the math flips instantly. Every dollar over $7M for a married couple gets taxed at 40%. That $3M estate suddenly owes taxes on $3M at 40%, that's $32M in federal tax alone before state estate taxes and inherited IRA income tax kick in. Your will doesn't stop this. Your trust doesn't stop this. Only strategic planning stops this. The 3 planning gaps that trigger this catastrophe. First, no portability election filed. When the first spouse dies, their unused exemption vanishes unless Form 706 is filed and portability is claimed. This is the most expensive mistake high-income families make. Research data from Form 706 filings shows that 60% of estates that should claim portability don't, leaving $300K, $500K on the table per family. That's a permanent loss because you can't file portability retroactively. For $4M married estate where one spouse dies without portability, the surviving spouse effectively loses access to $661M in exemption protection, costing their heirs an additional $264M in taxes when the second spouse passes. Now here's the twist most CPAs won't tell you. Even if you nail portability, the second mistake can wipe out everything you just saved. Second, retirement accounts titled in the wrong name. An IRA worth $800K passing directly to heirs triggers income tax on the full balance under the 10-year distribution rule under Secure Act 2.0. A trust structured correctly can split that income tax liability across beneficiaries and reduce the family's tax bill by $150K, $200K. That's not a small optimization, that's generational wealth protection. For a couple with $2M in combined IRAs. The difference between a poorly structured and properly structured inheritance strategy is the difference between heirs keeping $840K versus $960K, a $120K swing that depends entirely on one planning decision made today. Third, no gifting strategy in place. The annual gift tax exclusion for 2024 is $18,000 per person per recipient. A married couple can gift $36,000 per year to each child tax-free. Over 5 years before 2026, that's $180,000, $360,000 removed from the taxable estate permanently. Most families don't use this tool and leave hundreds of thousands of tax-free wealth transfer sitting on the table. If you have 3 adult children and a spouse, you could move $540,000 out of your taxable estate in just 5 years, completely tax-free. This single move can reduce the 2026 cliff impact by 30–40% for mid-range estates. Fourth, and this is the closing loop most advisors miss, business succession planning. If you own a business valued at $500K, $2M, that asset is fully exposed to the exemption cliff. A properly structured EBITDA-based sale to a family-limited partnership, combined with annual gifting, can reduce the taxable value by 25–35% while maintaining family control. That's $125K, $700K in tax savings depending on your business size. Here's what happens if you ignore this. The stakes are clear. High-income households may transfer 30–50% of their wealth to the IRS instead of to heirs. That's not a penalty, it's an irreversible outcome that happens after death. The window to prevent it closes at the